$700 billion. That's how much the biggest tech companies in the world are spending on AI infrastructure this year alone. And whether you own Bitcoin or not, that number is about to affect you directly. Let me ask you something straight. Right now, as you're watching this, Bitcoin is trading around $81,000, down from its all-time high of $126,000 it hit back in October of 2025. A lot of people looked at that number and said, it's over, the cycle is done. But what if they're asking completely the wrong question? Because while everyone is staring at the price chart, something else is happening. Something that is so large, so structural, and so deeply connected to Bitcoin's future that when the market finally figures it out, it may not give you time to react. Tech giants, Amazon, Google, Meta, Microsoft, are spending close to $700 billion on AI infrastructure this year alone. $700 billion in a single calendar year. And buried inside that number is a direct, undeniable, growing connection to Bitcoin. Not speculation, not a theory someone posted online. A real structural economic connection that is already playing out right now. Stay with me, because this is the breakdown you actually need. This video is for educational and informational purposes only. Nothing in this content constitutes financial advice, investment advice, or a recommendation to buy or sell any asset. Always conduct your own research and consult a qualified financial professional before making investment decisions. Before we get into it, if you're new here, the Wealth Continuum exists to break down the macro forces shaping wealth before they become mainstream headlines. If that sounds like your kind of channel, consider subscribing. All right, let's get into this. Here's what the mainstream financial conversation looks like right now. Bitcoin is down from its peak, rates are still elevated, volatility is back, and the narrative machine is running the usual loop. Is this a buying opportunity, or is the bull cycle already dead? But here's the thing. The people asking that question are trapped inside a very short time frame. They're measuring Bitcoin in weeks and months. What we're going to talk about today operates on a much longer clock. Because right now, in the background, away from the price tickers and the Twitter arguments, something structural is being built. The largest infrastructure build-out in modern history is underway. And the more you understand what's actually being built, the more you start to wonder whether Bitcoin and AI aren't just coincidentally growing at the same time, but whether they are actually linked by the same fundamental forces. We're going to cover analyst perspectives from across the spectrum tonight. Some of them are bullish, some of them carry serious warnings, and all of them are worth understanding because the picture only makes sense when you see it whole. Let's start at the beginning. To understand what's happening, you need to get a clear picture of just how serious the AI build-out actually is. This isn't a software trend. This isn't a product launch cycle. This is a global infrastructure war being fought with capital. Amazon has committed to $200 billion in capital expenditure for 2026 alone, up from $131 billion the year before. Google is right behind them with somewhere between $175 and $185 billion. Meta is projecting between $115 and $135 billion. Microsoft's AI business, just the revenue side, is already running at an annual rate of $37 billion and growing at over 123% year over year. Combined, the four largest hyperscalers are projected to spend close to $700 billion this calendar year on AI and data center infrastructure. Goldman Sachs puts the total annual AI capital expenditure number at $765 billion for 2026 alone, with their models projecting it growing to $1.6 trillion annually by 2031. NVIDIA's leadership has been even more blunt. They're forecasting global data center capital expenditure hitting $3 to $4 trillion by 2030. $3 to $4 trillion. To put that in context, that figure rivals entire national GDP cycles. Now, here's the question you should be sitting with right now. What does all of that infrastructure actually need to run? Two things: computing power and energy. Massive, uninterrupted, scalable energy. And here is where Bitcoin enters the frame in a way that most people are still completely missing. But here's what they're not telling you. The industry that has spent over a decade building large-scale energy infrastructure, negotiating long-term power contracts, and mastering the economics of distributed computing at scale, that wasn't Google, that was Bitcoin miners. Hit like, if this is the first time you've ever heard this framed this way, because I think a lot of people are about to connect some serious dots. For years, the story about Bitcoin mining was simple. Critics said it wasted electricity. Supporters said it secured the network. Both sides missed what miners were actually doing. They were quietly building the template for large-scale distributed, energy-intensive computing infrastructure. And in 2026, that infrastructure just became the most valuable thing in the tech industry. Here is what's happening right now. And these are real numbers, not projections. According to CoinShares, over $70 billion in AI and high-performance computing contracts have already been signed across the public Bitcoin mining sector. $70 billion. Core Scientific, which emerged from bankruptcy just 2 years ago, secured a $10.2 billion 12-year agreement with CoreWeave, one of the largest AI cloud providers in the world. TeraWulf has $12.8 billion in contracted high-performance computing revenue. Hut 8 signed a $7 billion 15-year lease for AI infrastructure with Google-backed FluidStack. Iron locked in a landmark 5-year partnership with Microsoft projected to generate $1.94 billion in annualized revenue at an 85% project-level margin. That last number is worth sitting with, 85% margins. Compare that to traditional Bitcoin mining margins, which have compressed to around 60%. CoinShares now projects that up to 70% of listed Bitcoin miner revenues will come from AI infrastructure by the end of 2026. Stay with me, because the next part is crucial. These aren't companies that decided to chase the AI trend opportunistically. These are companies that built exactly the right physical infrastructure: power access, land, cooling systems, computational density, years before the AI economy needed it. The question you should be asking yourself is this: was that coincidence? Or was Bitcoin mining always building towards something larger than most people understood? Comment below if you think the miner to AI pivot is one of the most underreported stories in finance right now, because I genuinely believe it is. Now, let's go a layer deeper. Because the miner to AI pivot isn't just a business story, it's a signal about what the new economy is actually built on. Energy, not just financial capital, not just software code, actual physical electrons through wire energy. Bloomberg NIF tracks this closely. Over 23 gigawatts of data center capacity was under construction globally at the end of the third quarter of 2025. About 3/4 of that was in the United States. Each hyperscale data center today can consume electricity equivalent to a small city. And that's creating a structural shortage, not just of chips, but of power itself. Power grids are being stretched in ways that utility planners weren't prepared for. Mara Holdings, one of the largest publicly traded Bitcoin miners, just launched a joint venture with Starwood Capital to transform existing mining sites into next-generation AI data centers, targeting approximately 1 gigawatt of near-term IT capacity, with a clear pathway to scale beyond 2.5 gigawatts. Think about that for a second. A Bitcoin mining company becoming a 1 gigawatt AI infrastructure provider. That's not a pivot. That's a complete redefinition of what these companies are. And here's the perspective from Michael Saylor that becomes a lot less abstract when you look at this data. Saylor has argued for years that Bitcoin is not just digital money, it's digital energy. A way of storing, transporting, and denominating the value of energy in a digital form. For a long time, that sounded more like philosophy than economics. But in a world where energy is the foundational input for the most important technological race in modern history, and where Bitcoin's network is fundamentally secured by energy expenditure, that argument starts carrying real economic weight. You need to understand this before I show you what's next. Because the energy story isn't just about mining companies converting their facilities. It's about what happens when the world's most powerful governments start treating Bitcoin itself as a strategic energy-backed asset. And that's exactly what's starting to happen. In March of 2025, President Trump signed an executive order establishing a strategic Bitcoin reserve. That's not a rumor. That's a signed executive order. The United States federal government is currently the world's largest known sovereign holder of Bitcoin, sitting on an estimated 328,000 Bitcoin as of early 2026. 328,000 Bitcoin worth tens of billions of dollars at current prices. Now here's what just happened this week. And this is where it gets really interesting. At the Consensus Miami conference on May 6th of 2026, Patrick Witt, the executive director of the President's Council of Advisors for Digital Assets at the White House, publicly stated that a major announcement on the strategic Bitcoin reserve is coming in the next few weeks. He confirmed the reserve is close to being operationalized. The Lummis Bitcoin Act, currently moving through the Senate, would go even further, authorizing up to 1 million Bitcoin in government purchases over time. If that legislation passes, analysts expect Treasury to begin its first official Bitcoin purchase in the fourth quarter of 2026. Let that land for a moment. The United States government potentially becoming a systematic buyer of Bitcoin in the open market, in the same year that AI infrastructure spending is reshaping global energy demand. In the same year that Bitcoin miners are converting their facilities into the backbone of the AI economy. Does this feel like isolated events to you, or does it feel like multiple massive forces converging in the same direction? This is where it gets really concerning for people who aren't paying attention. Because the window between when these forces align and when they're fully priced into markets can close very fast. Subscribe if you want us to keep tracking developments like this before they hit mainstream financial media. Let me bring in some perspectives from people who think about this professionally, because the smartest voices on this aren't all singing the same tune, and you deserve to hear the full picture. Raoul, CEO of Real Vision. Powell has spoken extensively about what he calls the exponential age, a period where AI, blockchain, robotics, and digital networks begin compounding simultaneously. His view is that crypto markets, including Bitcoin, thrive when three conditions align. Liquidity expands, technology adoption accelerates, and network effects strengthen. He's made bold claims in the past, including a prediction that the crypto market could grow from roughly $3 trillion to $100 trillion over the longer term, calling it just based on trend growth. His current framing is that the crypto cycle feels eerily similar to 2017 in terms of delayed momentum, but that the scale of institutional capital now involved means the eventual moves could be dramatically larger. Does that mean he's right? Not necessarily, but it means the framework he's using, macro liquidity plus technology adoption, is worth understanding. Cathie Wood of ARK Invest. Wood's team has maintained long-term Bitcoin price targets that many have called aggressive. Their models tie Bitcoin's long-term value to institutional adoption curves, where even modest portfolio allocation from large asset managers creates massive demand pressure relative to Bitcoin's fixed supply. The math they use isn't complicated. Small percentage allocation from a very large pool of capital runs into a hard supply ceiling of 21 million coins. Not everyone is connecting these dots the same way. Some macro analysts argue that the Bitcoin AI narrative is fundamentally loose, that energy usage correlation doesn't equal monetary value, and that the miner to AI pivot actually weakens Bitcoin's mining security model by diverting energy capacity elsewhere. That's a legitimate concern worth tracking. Others point to the fact that Bitcoin is currently trading roughly 36% below its all-time high set just 7 months ago, and that narrative momentum alone doesn't lift prices without fresh capital inflows. That's also worth remembering. Stay with me, because this next section is the one that almost nobody in mainstream finance is even discussing yet. Here's a thought experiment. It's not science fiction, it's based on things that are already happening. Google recently launched something called the Agent Payments Protocol, or AP2, in partnership with Coinbase, the Ethereum Foundation, and 60 other organizations. The protocol is designed to allow AI agents, autonomous software systems, to make payments on behalf of users using various methods, including stablecoins. Now ask yourself this deeper question. What happens when AI agents aren't just making payments for you, but making payments for each other? Imagine autonomous systems, buying computing resources from other AI systems, allocating capital across logistics networks without human approval, paying for energy in real time based on market prices, settling contracts between software agents in milliseconds. What kind of monetary system works best in that world? Not a system that's closed at 9 p.m. Eastern Time. Not a system that requires a 3-day settlement window. Not a system that can freeze accounts based on jurisdictional rules. A borderless, permissionless, 24/7, censorship-resistant monetary network. That description maps very closely to what Bitcoin was designed to be. Now, does that mean Bitcoin becomes the global settlement layer for the AI economy? That's a massive leap. And to be intellectually honest, it's still highly speculative. But here's what's not speculative. The demand for programmable, machine-readable money is real. The limitations of traditional banking rails in a machine speed economy are real, and the conversation happening in serious technology circles about what money looks like in an AI-first world is real. So, let me ask you directly. Do you think traditional banks and payment networks are ready for an economy where millions of autonomous AI agents are transacting simultaneously? Drop your honest answer in the comments. I'm genuinely curious what this audience thinks, because the implications of that question go far beyond Bitcoin. Let's be completely honest here. Because the most dangerous thing I could do is hand you a bullish narrative and walk away without showing you the other side. The AI boom creates serious structural risks, and some of them could actually complicate Bitcoin's trajectory rather than accelerate it. First, centralization pressure. As AI infrastructure gets concentrated in the hands of 5 or 6 hyperscalers, the pressure for governments to regulate digital assets alongside that infrastructure intensifies. The same governments that are signing strategic Bitcoin reserves today could pivot to aggressive capital controls, central bank digital currencies, or surveillance-level financial monitoring if political winds shift. That is not a hypothetical. It is a trajectory that several major economies are already actively pursuing. Second, the liquidity trap. AI infrastructure spending at $700 billion a year represents capital being absorbed by physical build-out, land, power, chips, construction. If that capital comes partly at the expense of financial market liquidity, the macro environment for speculative assets, including Bitcoin, could tighten before it expands. Third, Bitcoin's own competition. The same infrastructure revolution that benefits Bitcoin's narrative also creates competition. Enterprise-grade blockchain networks, central bank digital currencies, and AI-optimized payment rails are all being built simultaneously. Whether Bitcoin maintains its dominant position in a world of digital currency competition is not a settled question. Analyst Alden, who has written extensively about Bitcoin's monetary properties, makes the point that Bitcoin's long-term value case depends not just on adoption, but on whether it maintains its properties of being the hardest and most credibly neutral monetary asset. If that credibility gets diluted through protocol changes, concentration of mining power, or regulatory capture, the thesis breaks down. But here's what they're not telling you about all of these risks. They existed in 2020 as well. And Bitcoin's market cap has grown from about $200 billion then to $1.33 trillion today. The risks are real. They're also not new, and the forces accelerating on the other side of the ledger may be larger than anything we've seen in a previous cycle. Let me give you the honest summary. Bitcoin is sitting at roughly $81,000 today. It hit $126,000 just 7 months ago. A lot of people are disappointed by that gap. But here's what actually happened in that same 7 months. Tech giants committed to spending $700 billion on AI infrastructure in a single year. Bitcoin miners signed over $70 billion in AI computing contracts, converting their energy infrastructure into the backbone of the AI economy. The United States government formalized a strategic Bitcoin reserve, now holding an estimated 328,000 Bitcoin, and a White House announcement on operationalizing that reserve is expected within weeks. Google launched a protocol enabling AI agents to make crypto payments autonomously. And Strategy, formerly MicroStrategy, now holds over 800,000 Bitcoin on its corporate balance sheet, representing more than 3% of all Bitcoin that will ever exist. None of those things existed in the same way 18 months ago, so the question isn't whether the price chart looks disappointing relative to the all-time high. The question is whether the structural foundations underneath Bitcoin have gotten stronger or weaker while the price pulled back. And by almost every structural measure we can look at, they've gotten significantly stronger. Whether that translates into a price supercycle in the near term, the medium term, or not at all depends on variables nobody can predict with certainty. But dismissing the convergence of AI capital, sovereign Bitcoin adoption, infrastructure transformation, and the emerging machine economy as noise, that feels like the most expensive mistake you could make. So here's the question I'll leave you with tonight. We're watching the largest technology infrastructure build-out in modern history. We're watching governments treat Bitcoin as a strategic reserve asset for the first time. We're watching Bitcoin miners transform into the physical backbone of the AI economy. And we're watching the early architecture of a machine-to-machine payment economy being assembled in real time. What if all four of those things are not separate trends, but one single trend, seen from 4 different angles? And what happens to the asset sitting at the center of that picture when the rest of the world finally connects those same dots? That's the question worth sitting with. If you've been watching the Wealth Continuum for a while and this video finally made the picture click for you, do me a favor and drop the word convergence in the comments. I want to see how many of you are tracking this the same way. And before you go, what should we break down next? AI and gold? The strategic Bitcoin reserve legislation timeline? Or the machine economy and what it actually means for traditional banking? Drop your suggestion below. The next video topic might come straight from this comment section. Hit like if you think the AI Bitcoin connection is more serious than mainstream finance is treating it. Comment below if you're holding Bitcoin through this pullback because of the structural thesis, not just the price chart. Share this with someone who's only looking at the price and completely missing the infrastructure story underneath it. Subscribe if you want macro breakdowns like this one before they become the conversation everyone is having 3 months from now. The Wealth Continuum. Stay alert, because the next financial era isn't approaching. It's already under construction.